GCC, they expect that the banks can face the outflow of the foreign cash, and they expect that $200 billion will move or will be withdrawn. Will there be bigger hedges to face this conflict when it comes to the GCC banks?
First of all, thank you for having me on the show. So right now, what is happening is we are facing a sort of an unprecedented Middle Eastern crisis, because for the first time we are going to see Iran and Israel directly fighting out against each other. So far, it had been a war against the proxies and other such elements. Now, the biggest risk for the Gulf banks, as you've rightly pointed out, is the huge outflow of expected cash that can likely occur. So, since the COVID times, most of the GCC banks, specifically UAE and Saudi, they had a stable cash flow because of the rise in oil prices as well as the booming real estate sector. But the overall trends, the increasing commentaries that we are seeing is rising cost of risk as far as the Gulf banks are concerned. If we take the case of UAE banking sector, there are already fears that the real estate market has basically sort of topped out, cash flow pipeline about to stabilize over the next 2 to 3 years. So, should the war stay prolonged, should the crisis not calm down easily, we are likely going to see a rise in the non-performing loans as well as rise in the cost of risk factors.
So the percentage of the provisions will be during this period, Mr. Bhavik, and which are the GCC banks that are capable of keeping their provisions not very high during this war?
Well, at this point of time, we are seeing Saudi bank, specifically led by Al Rajhi Bank, which has a huge, you would say, government subsidy as well as oil-related wealth stockpile to stay intact. If we talk about the UAE players, our favorite bet would be on FAB Bank because of the overall capital structure of the bank. So if you look at the overall banking structure profile, we are taking the case of the overall spending growth as well as the kind of deposit interest mix that the bank specifically has. Dubai banks are more exposed to a scenario of falling interest rates as compared to Abu Dhabi banks. So our topic as far as the UAE bank is concerned is FAB Bank.
We have noticed lately, Mr. Bhavik, that the GCC banks are having debt issuance, whether evaluated by the local currency or the dollar. The GCC debt issuance has increased by 10%. In light of this conflict, do you believe that it will continue this borrowing and having this debt issuance?
So what has happened since the start of the year? So before this conflict started, oil prices were in a way on a losing ground. So we saw something like a 10 to 15% correction since the end of the May. Now, because of this conflict, oil prices have spiked up. In a way, this could somewhat provide some relief to Saudi banks as well as the overall Saudi funds. So maybe some amount of comfort as far as dollar issuance is concerned. But again, oil continues to be a very tricky commodity, because even in a scenario where oil prices rises, should the regional sentiment completely draw down, then it could be again difficult for these banks to raise funds. And again, the overall volumes might increase, but the yields would basically increase, putting the pressure on these banks' balance sheet.
Mr. Bhavik Mehta, Vice Head of Research, Century Financials, thank you so much for being with us. It was a pleasure hosting you.
Thank you.